Imagine walking into a bank to open a savings account. You hand the teller $1,000. The teller smiles, takes your money, and immediately shreds 500 of those dollars right in front of your face. Then they look you in the eye and say, "Congratulations, this is the smartest financial decision you will ever make." If that happened, you would call the police. You would call it a scam. But when we wrap that exact same transaction in a leather folder and call it whole life insurance, we call it financial planning. Today, we are going to look at one of the most contentious, expensive, and misunderstood products in the financial world. We are going to break down the math behind permanent life insurance versus buying term and investing the difference. We will see why your neighbour swears by it, why your financial advisor might be pushing it, and why the math suggests it might be a six-figure mistake for your future. Before we get into the ugly numbers, we have to define exactly what we are arguing about. In the red corner, we have term life insurance. This is the simple one. It is pure protection. You pay a premium for a specific period, usually 10, 20, or 30 years. If you die during that time, your family gets a big check. If you don't die, the policy expires and you walk away with nothing but the satisfaction of being alive. It is effectively renting insurance. In the blue corner, we have whole life, or permanent insurance. This is a bundle. You are buying a death benefit that lasts until the day you die, effectively forever, combined with a savings account called cash value. The sales pitch is that you are not just renting coverage, you are building an asset. It sounds responsible, it sounds sophisticated, but the devil is in the details, and specifically in the price tag. If you are enjoying this deep dive into the financial weeds, do me a favor and hit the like button. It is the best return on investment you will get today, considering it is free. Now, let's look at the premium gap. This is where the argument usually starts. If you are a healthy 30-year-old looking for $500,000 of coverage, a term policy might cost you around $25 a month. That is the price of a couple of streaming subscriptions. A whole life policy for that same $500,000 payout? That is going to run you closer to $400 or $500 a month. We are talking about a difference of 10 to 15 times the cost. The insurance agent will tell you that the extra money isn't lost, it is going into your savings. But as we are about to see, that savings bucket has a massive hole in the bottom. To understand why whole life is so expensive, you have to understand the problem the insurance company is trying to solve. With term insurance, the company is betting you will live, and you are hedging against the risk that you won't. Statistically, most term policies expire without paying out a dime. That is why they are cheap. The insurance company collects premiums from thousands of people and only pays out a few claims. But with whole life, the payout is guaranteed. Unless you cancel the policy, the insurance company knows for a fact that one day they will have to write that check. Because the payout is a certainty, they have to collect way more money from you up front to fund it. They are not just insuring you, they are creating an endowment for your future death. This requires a massive accumulation of capital, and guess who has to supply that capital? You do, through those massive monthly premiums. Here is the part that usually gets left out of the brochure. You might think that if you pay $5,000 a year into a policy, you have $5,000 of value. You would be wrong. In the first year of a whole life policy, a massive percentage of your premium does not go into your cash value. It goes into the agent's pocket. It is common for commissions to range from 50 to 90% of the first year's premium. That means if you write a check for 10 grand, your agent might be taking home 9 grand of that immediately. This is why your cash value in the first couple of years is often zero or close to it. You are in the hole immediately. It takes anywhere from 10 to 15 years just to break even, meaning it takes over a decade for your cash value to equal the total amount of premiums you have paid. If you tried to sell an investment product that guaranteed a negative return for a decade, you would be laughed out of the room. Yet, this is sold every day at kitchen tables across America.
So why do people buy it?
If the math is so bad in the early years, why is this a multi-billion-dollar industry? It comes down to two things: fear and forced discipline. The pitch is incredibly seductive. They tell you that the stock market is a casino. They show you charts of market crashes and ask if you want to gamble with your family's security. Then they pivot to the whole life policy. They show you a chart that only goes up. It never crashes. It grows tax deferred. It feels safe. They also tell you that you are bad at saving. They say, sure, you could buy term and invest the difference, but will you actually invest the difference? Or will you spend it on pizza and vacations? They sell whole life as a forced savings account, effectively charging you a massive fee to protect you from your own lack of discipline. It is a very expensive way to outsource your willpower. The alternative to this expensive bundle is unbundling. This is the famous philosophy of buy term and invest the difference. The logic is simple. You buy the cheap term insurance to cover your catastrophic risk during the years you actually need it, when you have a mortgage, young kids, and limited assets. Then you take that massive difference in premiums, that extra $400 or $500 a month, and you put it into a low-cost, diversified investment portfolio. The goal here is self-insurance. By the time your 20 or 30-year term policy expires, you don't need the death benefit anymore, because your investment account has grown to the point where your family is fine even if you aren't there. You stop renting the safety net because you have built your own foundation. But does the math actually hold up? Or is that just a nice theory? Let's stop looking at theory and look at hard numbers. If you think the safety of whole life makes up for the cost, I want you to see exactly how much that safety costs you over 30 years. Let's take our hypothetical 30-year-old. He buys a whole life policy for $5,000 a year. The illustration says that in 30 years, at age 60, he will have around $250,000 in cash value. That sounds great. $250,000, safe, guaranteed. But now, let's look at the alternative. He buys a term policy for $500 a year. He takes the remaining $4,500, the difference, and invests it. If he puts that money into a boring S&P 500 index fund and gets a historical average return of roughly 7 to 8% compounding, where is he at age 60? Is he behind? Is he even? When you run that compound interest calculation, the result is staggering. That $4,500 a year, compounding at 7% for 30 years, grows to roughly $450,000. Remember, the whole life policy offered about $250,000. The simple strategy of unbundling created nearly double the wealth. That is a $200,000 gap. That isn't just a rounding error, that is an entire retirement home. That is college tuition for 2 kids. The safety of the whole life policy effectively cost you $200,000 in opportunity cost. And here is the kicker. That investment account is fully liquid. You can sell it, move it, or spend it whenever you want. You don't have to ask an insurance company for permission to access your own money. There is another factor that insurance illustrations love to ignore, and that is inflation. Whole life policies often boast returns of 3, 4, maybe 5% eventually. But if inflation is running at 3%, your real return is practically zero. You are just treading water. Equities, real estate, and diversified portfolios have historically outpaced inflation significantly over long timelines. By locking your money into a contract that yields bond-like returns, you are exposing yourself to purchasing power risk. $250,000 sounds like a lot of money today, but in 30 years, it might only buy you a used Honda Civic. By choosing the safe route, you are actually taking a massive risk. The risk that your money won't grow fast enough to keep up with the cost of living. Now the insurance agent will jump in here and say, "But Tom, you're forgetting the dividends. Our company pays dividends." This is one of the most confusing parts of the sales pitch. In the world of stocks, a dividend is a share of profits distributed to owners. In the world of whole life insurance, a dividend is legally defined as a return of excess premium. Read that again. It is a refund of an overcharge. The IRS literally classifies it that way, which is why it isn't taxed. The company overcharged you just in case things went wrong. They didn't go wrong, so they gave you some of your own money back and called it a dividend. While these dividends do help the policy grow, they are not magical profit distributions. They are simply a mechanism to adjust the cost of the policy after the fact. Do not confuse them with the dividends you get from owning shares in a profitable business. If you spend any time on TikTok or Instagram, you have seen the videos. A guy in a fitted suit tells you that the wealthy don't use banks. He says they use a secret tax loophole to become their own bank. He is talking about infinite banking, or bank on yourself. This is a strategy that uses overfunded whole life insurance policies to create a pool of cash that you can borrow against. The pitch is that you borrow from yourself, pay yourself back with interest, and capture all the money that would have gone to a traditional bank. It sounds incredible. Why pay Visa 12% when you can pay yourself? The problem is, once again, the math. When you borrow against your policy, you are not actually borrowing your own money. Your money stays in the policy as collateral. You are taking a loan from the insurance company and they are charging you interest. You have to pay that interest. The proponents of this system claim that because your cash value continues to grow while you have a loan outstanding, you are engaging in arbitrage. If the policy pays you 4% and the loan costs you 5%, the net cost is small. But wait, why would you pay a net cost to access your own money? If you had that money in a high-yield savings account or a brokerage account, you could just withdraw it. Cost zero. With the insurance scheme, you are paying a spread to access liquidity that you provided in the first place. Furthermore, if you don't pay that loan back, the interest compounds against you. It can eat away at your death benefit and eventually cause the policy to lapse. If the policy lapses with a loan outstanding, you get hit with a massive tax bill on all the gains you thought were tax-free. It is a high-wire act that requires perfect execution. The other issue with these banking concepts is complexity. I have reviewed policies for people who tried this. They have spreadsheets that look like NASA flight plans, just to track their premium payments, loan repayments, and dividend reinvestments. Life is messy. You lose a job. You get divorced. You forget to check the mail. If you mess up the funding of these policies, they can implode. Compare that to the buy term and invest strategy. You have an automated transfer to an index fund. That's it. You don't need a consultant or a spreadsheet to manage it. In personal finance, simplicity is an asset. Complexity is a liability. Complexity hides fees. Complexity creates points of failure. The be your own bank strategy is the ultimate example of manufacturing complexity to sell a product that most people simply do not need. So who actually wins in the infinite banking scenario? The insurance agent. These policies require massive premiums, often tens of thousands of dollars a year, to work properly. Remember that commission structure we talked about earlier? A $20,000 annual premium generates a massive payday for the person selling it. This is why you see so many influencers pushing it. It isn't because they discovered a secret of the Rothschilds. It's because the compensation structure for selling permanent life insurance is one of the most lucrative in the entire financial services industry. If you are ever confused about why a financial product is being pushed so hard, follow the money. In this case, the money leads directly from your bank account to the agent's commission check. Now, before I get an angry email from every insurance agent in the country, I have to make a concession. Whole life insurance is not a scam in the legal sense. It is a contract, and it does exactly what the contract says it will do. And there are people, a very small group of people, for whom this product actually makes sense. We need to define who those people are so you can see if you are one of them. The first group is the ultra-wealthy who are facing estate tax issues. If you are worth $20 or $30 million, the government is going to take a huge chunk of your estate when you die. Whole life insurance can provide immediate, tax-free, liquid cash to pay those taxes so your heirs don't have to sell the family business or the farm. For these people, the low return doesn't matter. They aren't buying it for the investment. They are buying it for the liquidity event. The second legitimate use case is for families with special needs dependents. If you have a child who will never be able to support themselves financially, you need to ensure there is money for their care after you are gone, whether you die at 30 or at 90. Term insurance expires. Whole life is permanent. In this scenario, the guarantee is the most important feature. You cannot afford to outlive your coverage. It acts as a permanent safety net for a permanent problem. If you fall into this category, whole life is a valid and important tool. But notice the pattern here. These are specific, permanent needs. Most of us do not have a permanent need for insurance. We have a temporary need to replace our income while we are working and raising a family. There is one final group, the high-income earner who has maxed out everything else. If you are putting the maximum into your 401k, your IRA, your HSA, and you still have cash piling up that you want to shelter from taxes in a conservative vehicle, whole life can act as a bond substitute. It's a way to get a 3 or 4% tax-advantaged return with very low volatility. But this is the last bucket you fill, not the first. You only look at this after you have built a robust portfolio of stocks and real estate. The problem is that agents sell this bond bucket to 25-year-olds who have credit card debt and no retirement savings. That is financial malpractice. You don't worry about tax-efficient bond placement when you are paying 18% interest on a Visa card. So, take a look in the mirror. Are you worth $20 million? Do you have a special needs dependent requiring lifelong care? Have you completely maxed out every other tax-advantaged account available to you? If the answer is no, then you almost certainly do not need whole life insurance. You are paying a premium for features you do not need and cannot afford. You are buying a Ferrari to deliver pizzas. It will do the job, but it is a terrible use of capital. For 95, maybe 99% of the population, the boring, simple path of term insurance plus investing is mathematically superior. This brings us to the most important part of the video. If you agree with the logic, what do you actually do? How do you execute the buy term and invest the difference strategy without messing it up? Step 1 is to get the insurance in place before you cancel anything. Do not, I repeat, do not cancel an old policy until your new one is active. Health changes. You might not be as insurable as you were 5 years ago. Go online, shop for a term policy. Look for a term that covers your working years, usually until age 60 or 65. Aim for coverage that is 10 to 12 times your annual income. If you make 100 grand, get $1 million policy. It is shockingly cheap. Lock that in. Once you have the approval and the policy is in force, then and only then do you look at your old whole life policy. Step 2 is the breakup. If you have a whole life policy you realize you don't want, you have options. You can surrender the policy and take the cash surrender value. Yes, there might be surrender charges, and yes, you might get back less than you paid in premiums. That hurts. It feels like losing money. But you have to view those past premiums as a sunk cost. That money is gone. The only question is, what is the best use of your money moving forward? Is it better to keep throwing good money after bad, or to cut your losses and switch to a better strategy? Often, the math says take the hit, grab whatever cash value is left, and move on. Be prepared for your agent to fight you. They might try to sell you a reduced paid up option or guilt trip you. Stand firm on the math. Step 3 is the most critical. You must actually invest the difference. If you save $400 a month on premiums and just spend it on lifestyle creep, this strategy fails. You end up with no permanent insurance and no investment account. You have to automate this. Set up a monthly transfer from your checking account to a brokerage account for that exact amount of money you saved. Put it into a total market index fund or a target date fund. Treat it like a bill. It is not optional. It is your self-insurance fund. If you do this religiously, you will see that account grow. In 10 years, you will likely have more in that account than you ever would have had in cash value, and you will have total control over it. When you unbundle your insurance from your investments, you gain flexibility. If you have a bad year and can't contribute to your investments, you can pause. Your insurance doesn't lapse because the term premium is small and manageable. If you hit a home run with a business idea and want to invest more, you can dump extra cash into your brokerage account without limits or fees. You are in the driver's seat. You are not relying on an insurance company's black box formula to determine your wealth. You are stripping away the fees, the commissions, and the complexity and getting back to the raw power of compounding. It is boring, it is simple, and it works. So, is whole life insurance a scam? Technically, no. But is it a bad deal for the vast majority of people? Absolutely. It is a product that solves a problem most people don't have, at a price most people shouldn't pay, with a commission structure that incentives agents to sell it to everyone regardless of fit. It thrives on complexity and fear. It relies on you not understanding how compound interest works. It relies on you believing that you need a corporation to force you to save money. The moment you take responsibility for your own financial discipline, the value proposition of whole life falls apart. I want you to check your own policies. If you have a whole life policy, look at the cash value. Look at the premiums paid. Calculate the return. If you have a term policy, pat yourself on the back. If you found this breakdown helpful, or if you are an insurance agent who is currently typing a furious comment, let me know below. I read the comments, especially the angry ones. They help the algorithm. If you want to see more breakdowns of financial products that might be costing you a fortune, make sure you are subscribed. We are going to keep tearing down the complexity until the math is clear for everyone. Remember, nobody cares about your money more than you do. Not your agent, not your bank, and certainly not the insurance company. Take control, run the numbers, and don't pay for fees you don't need. Thanks for watching, and I will see you in the next one.